All right, good evening, everyone. My name is Matthew McQuaig, analyst here at CattleFax and one of tonight's two presenters. Thank you, everyone, for joining us. As you all have joined, you were automatically muted. If you have questions throughout the presentation, you should be able to type them in the sidebar and we'll be able to see them, though no one else can, and we can answer them as convenient. For tonight, we will be discussing, or we will start with an overview of the corn and hay situation and outlook through the summer, along with the cattle supply and demand expectations. Follow that up with an outlook for our summer and fall calf markets, and then we'll finish or wrap up with our cow-calf survey results. At this point, I would like to introduce Mary Kurzweil, who will start us out tonight. Mary, you can take the screen.
Thanks, Matt. Can you hear me, just to make sure?
I can hear you, yes.
Okay, perfect. Yes, thanks everyone for being with us today. We're glad to have you here, and I'll walk us through, like Matt said. First, we'll start with the weather, and then we'll get into corn and hay production and expectations there. And then we'll get more into the cattle supply and what we're expecting with cattle, beef supply, a little bit of a price outlook, and then Matt will go over the cow and calf survey results. So to get us started here, yeah.
Let me interrupt you. We're still just seeing the main slide.
Oh, sorry about that.
There we go.
Okay.
Thanks.
Yeah. Thanks, Matt. Okay, so to get started here, looking at weather, we're in a lot better shape than what we were a year ago, and then especially 2 years ago. So when we were putting this together, I got to see the 2022 maize drought index, and that was about all red, orange, and yellow. So you can see here that we've only got a few spots of the red, and really we're in pretty good shape as we move through spring and into the summer. And we're seeing pretty good precipitation now. So Matt Makins, our weatherman, sent this around to us about precipitation that's coming through now. We've seen a lot of this already. I know here in Colorado and in my home state of Missouri, we've already seen quite a bit of this moisture that he had sent around. But that's just going to really help us as we move into the spring and summer. Just keep the soil moisture up, and really gets good precipitation if you look in the Midwest through the Corn Belt region. So that should be really supportive to a good production cycle as we look ahead. But that said, we spent a lot of time on this over the last few years talking about the La Nina weather cycle. This year we moved into the El Nino, and now it appears we're moving right back to the La Nina. And as we look at the probabilities of what kind of weather system we'll see, April, May, June is pretty much locked in at a neutral, and May, June, July is as well. But by the time you get to June, July, and August, it's pretty much a coin flip on if it's more of a neutral pattern or more of this La Nina pattern. So as we look at this, this is a pretty pivotal time on whether we'll be neutral or La Nina. But then as we look ahead from there, it's pretty much guaranteed that by this fall, and especially by the winter, we're probably going to be back to that La Nina pattern. And so why this is important is if we look at what we typically see in a neutral versus a La Nina, the neutral summers have pretty good precipitation spread throughout the U.S. So you can see especially the Corn Belt region has above average moisture to at least average moisture for most of that. Whereas if we see a La Nina summer, the Corn Belt area is still fine, but if we look at the plains, the southern plains especially, where we have a lot of cows, that would look a lot drier. So we're hoping that we can hang on for more of a neutral pattern as we look ahead towards the summer. But then by the time we get into the fall, the probability jumps up for the La Nina weather pattern. So then we're expecting more dryness in the south and central part of the U.S. And at that point, it's not as pivotal for crop production that we see a lot of moisture, but it is important for pasture, hay production, and then looking ahead for next year. So our El Nino weather pattern was shorter lived than what we would have liked to have seen. But if we can hold on to a neutral pattern for a little bit longer, that should set us up for pretty good grazing conditions as we look ahead for the summer and the fall. And so expecting pretty good conditions for growing, we've got our corn supply all in all about steady with year ago, but this is a lot of numbers to look through, so I'll break it down a little bit. So we're looking at quite a bit of fewer acres as we look according to the USDA expectations. So those are down about 4.5 million acres. And so I think there's some wiggle room there. And I think that could be important as we look, because this is using the trend line yield expectation, so 181 bushels per acre. So I think that we could fall a little bit short of that, because that would be the highest production we've seen. It's just following the long-term uptrend. But even if we fall a little short, if we have a few more acres, that should hold production at around these levels. But we're starting the year off with a lot more beginning stocks. So that's up 662 million bushels. And so even with production down, we ought to be able to keep pretty good stocks to use, pretty good supply compared to what we're using. We've got demand up. Some of this is going to be that just cheaper corn is going to be used more for, well, like they always say, a hog will eat a lot more, a hog or cattle will eat a lot more $4 corn than $8 corn. So some of that's going to be lower prices driving more usage. But I do think there's some wiggle room as you look through these numbers as well. Feed and residual being up, that could happen, but we are seeing fewer cattle and a smaller breeding hog herd as well. So that number is a little bit flexible, but all in all, what this gives us is about a 14% stocks to use. So that's important because that's a pretty comfortable range. And it's up a little bit from what we saw a year ago and should keep us in a more comfortable price range as well. So as we look, what we saw a few years ago was a stocks to use below that 10% mark. And that's what really helped drive those prices up above the $7 that we saw for a little bit. And now that we're at a more comfortable supply situation, we do see these lower prices. And so with what our expectations are for corn and that 14% stocks to use, that would give you a $5 a bushel corn price for December of 2024. So just given that supply and the long-term demand curve that we see here, that would suggest a $5 a bushel price. If we do end up with a little bit more supply, that would indicate prices could be a little bit lower and suggest some weakness. But if we don't see as good of production as we expect, or we have more usage, that would put us at a lower stocks to use and then a little bit higher prices. But all in all, we should be at a pretty comfortable price position, which should keep the corn a little bit more range bound, which is kind of what we've been seeing here in the last few months, between that $4.50 to $5 range. But like we like to say, we haven't even killed the corn crop once. And typically you see the corn crop get killed or threatened a few times during the growing season, where concerns about production will drive prices higher. So we haven't seen that yet, but do expect more volatility in the futures market than what these charts would suggest. And if we look at where we're tracking so far, we're maybe a little bit behind a lot of years if you look at our corn crop progress. So our percent planted as of Monday was right at 70%. Last year we were around 76%, so a little bit higher, but we're still at a pretty comfortable range historically. Just need to continue to see that corn go in the ground, even with all the moisture we're seeing nationwide. So if the rain does prevent some planting, that could be a concern that would drive prices a little bit higher, because that would just be concern for overall production. But as of now, I'd say that we're pretty well on track with our percent planted. Moving into hay, the important things here are that we're seeing a little bit fewer acres of hay being planted here, but expecting more production. And that's just with more moisture in the ground to start the year. And so that should help keep production a little bit stronger than last year. And we're already seeing with prices, our overall stocks are still at a pretty historically low level as we look here, but definitely up from where they were in 2022. So this is the December 2023 stocks. They were significantly higher than what they were in 2022. So that's really helped move prices lower, just as we're in a more comfortable supply. And then we also just have a smaller cow herd, and so that's less usage for the hay and also helping drive these prices a lot lower than what we were seeing a year ago, running below $200 a ton, whereas last year we were up above 200 a ton for quite a bit of time there between 2022 and 2023. So expecting to keep these prices lower, maybe a bit above the 10-year average, but as we do get into more comfortable supply, we ought to keep seeing these prices more range bound and at more of the historical long-term average level. And so like I said, we are seeing a smaller cow herd. Between the drought we've seen over all the years, we've just been in a massive liquidation phase for quite a bit of time, and we moved lower again in 2024. This has us down again in 2025, and though I do think we're recovering, we are starting to see a little bit of retention for heifers and less beef cow slaughter. It just takes some time to build that back up, and so we'll look at that in just a couple slides. But the beef cow herd started the year down another 600,000 head. Expect it to just tick lower again next year before we really start to see the impact of keeping heifers back and rebuilding. So all in all, just a smaller beef cow herd, and that's just going to mean a smaller calf crop and smaller inventories as we look ahead for all chains of the cattle system. But like I said, cow slaughter is down a lot. So throughout 2023, we ended up being down about 400,000 head. That was a big decline, but that's coming off of these massive numbers that we saw in 2023. So it still was at a culling rate that would suggest that we were in liquidation because it's still elevated in one of the top 5 cow slaughter years if you look historically. And that's just driven by a lot of drought that we saw. It was down 11%, but there was still some drought forest slaughter. And then the dairy cow slaughter was up 1% last year. But year to date, we're running 13% lower for the beef cow slaughter and 16% down in the dairy cow slaughter. And that's 13% lower in the beef cow slaughter from an already lower number last year. So expecting to see another 700,000 head decline, which would start to show that we're more at a stabilization rate rather than a liquidation culling rate and slaughter percentage. But what's going to hold us back from really increasing that beef cow herd for another year until we get into 2026 is the lack of heifer retention and beef replacement heifers. So we started the year down again. We were already at the lowest that we'd seen at least in the past 30 years to start last year, 2023. And then it moved lower again just because we weren't able to retain heifers and they kept going on feed. And so as we look, we do expect to see that those tides change as we look at 2025. Like I said, we should see pretty good grass conditions and pasture conditions that'll help allow that, but it still will take some time before those get counted in the beef cow herd. So if they're a replacement heifer in 2025, then they don't get counted as a beef cow until 2026. So that's some of that lag before we start to see an increase in the cow herd, but we didn't see enough retention last year, and that really shows up as we look at these replacement heifer numbers. And so far this year, we're really not seeing a lot of that either. As we look at heifers as a percent of cattle on feed, we're still at one of the higher levels that we've seen. It has ticked lower here lately, but it's still pretty elevated. Historically, we would say 37 to 37.5% is maybe the percentage that you start to see a switch from liquidation to expansion, that bar could be a little bit higher now because we are seeing more beef on dairy in the mix. And while this doesn't add cattle, it does add more female offspring from the dairy side, because rather than just sending all of their dairy offspring, the dairy bull offsprings, it's more of a 50-50 mix when they send the beef on dairy over. And so that probably adds some of the percent for heifers as a percent of cattle on feed, but we're still not at a phase or at a place that would really show that we're keeping heifers back and retaining them. And that also shows up here in the sales receipt, because heifers as a percent of sales has just continued to rise and is up above that range compared to the 10-year average. So still moving a lot of heifers. Now, some of these could get developed as replacement heifers, but still with this much movement tells you that a lot of producers aren't keeping them back. So a lot of heifer movement and not a lot of retention up to this point when we look at heifers on feed. And even with keeping the heifers in the slaughter mix, we're still looking at steer and heifer slaughter down about 700,000 head this year, and then another million head in 2025. So we finished 2023 down a little bit more than expected, and some of those have been added to the supply this year. So this year we don't see as extreme of a decline, but still a pretty big drop as we look compared to where we were in 2021 and 2022. So continuing to see that decline. Through the first quarter, we were down about 210,000. And so that's about 3%. And so through the summer, we've got a more available supply. And if we look at last year's slaughter through the summer, that was already down. So those numbers will probably be a little bit closer to a year ago, and then more of a decline that we'll see in the second half as we look at slaughter. So like I was kind of saying, we built up a little bit of a larger supply of cattle on feed. So through the end of last year, slaughter wasn't maybe as big as we expected, and that cattle on feed number grew a little bit. And we've seen it above year ago as we started this year. And part of that is just keeping them on feed a little bit longer, adding some days. And so just having them on feed that much longer does create a larger cattle on feed. And that's a long-term trend that we're going to see as we compare this data historically. But as we look ahead, we had placements. We're expecting to see placements down a lot in April. That report comes out on Friday. But with that expectations and then our strong slaughter levels that we saw, we expect cattle on feed to move below year ago as we look at May. And then it should remain below year ago on ahead, just out of the fact that we've got fewer cattle to place in our overall supplies. Now, one thing that we have been seeing is a lot more weight has been added to cattle. So carcass weights for steers and heifers are running pretty consistently about 20 pounds above year ago. And so you can kind of see this with the cold carcass weights. These are expected to be up about 16 pounds as we look for the whole year. And while that seems extreme, some of this is adding days, some of this is adding weights, because there is incentive to add weight to cattle due to the corn prices being low enough and cattle continuing to gain well enough that adding weight is economical to do. Some of that is also taking some of the non-fed slaughter out, and then also expecting to see fewer heifers as we move through the year. That'll just make the average cold carcass weight higher because you just have a higher percent of them being steers. But all in all, that's a pretty big increase. So although we've got the 700,000 head decline for the fed slaughter, between the increase in weights and then seeing more imports to start the year and fewer exports, we're expecting the per capita supply to be down about a pound. So going into this year, we would have expected that to be a little bit more severe, but the increases in weights is helping to offset some of those losses in slaughter that we're going to see. And so then the question comes, will we see enough demand to keep these prices higher? And or are we going to kill off demand? And up to this point, we've seen demand hold strong even at these higher prices. So looking at the retail demand, you can see that it's not as high as maybe it was in 2021, but still historically elevated. And that set a pretty strong retail price at $8 a pound for the all fresh retail price. But we are seeing still pretty good demand traction at these levels. And these higher prices are needed to help ratchet down the supply, but it's comforting to see that demand is holding together up to this point at the retail level. And then that can be passed back to other parts of the supply chain as we look between the cutout and then the fed price, and then back down to calves and feeders. So we've seen that already here as we look. We saw a new high in fed cattle prices here in the spring. And here in the next couple of weeks, we could see another increase here that could retest those highs. But then we should still see that seasonal break that you would expect through the summer before we move higher again into the fall, a fall rally when beef demand picks up again. So we're expecting more of a range-bound market, and that's what these futures would show as well. So although these futures prices do put in a little bit of a decrease through the summer, it's not nearly as big as what a seasonal break would be, and that could just be demand supportive, keeping prices just more range-bound rather than the normal seasonal that sees a pretty large break into the summer. And then that also might mute the rally some in the fall, but still be relatively strong prices as we look at a long-term average kind of range. And so then that should get passed back to the feeder cattle and then the cow-calf producers, especially as you look at our outside supply situation. So as we finish the first quarter, we've got our outside supplies down 4.5% from a year ago, which were already the smallest levels that we've seen since 2014 and 15. So at these small supply levels for outside supply, that's really going to continue to be supportive to the feeder cattle and calves, which we're already seeing. Throughout last year, we already were able to move the annual average price up about $52 per hundredweight, and prices are already moving higher again this year. And following a seasonal trend to a point, we expect upside potential up to that 270, 275 range. And then the breaks might be a little bit more muted. Just follow the seasonal pattern a little bit more, because there won't be enough supply to really force prices lower like you'd see in that 20-year index. So trending higher, but could be a little bit slower depending on what the deferred live cattle futures do. If that continues to be extremely range bound, that could be somewhat limiting to these feeder cattle. But looking at calves, the calves were able to increase $70 a hundredweight throughout last year on an annual average, and are trending higher again this year, looking to average another maybe $30 higher as we look at 2024. And following that seasonal pattern, we should see them hold these strong levels for the next several months before they are likely to break lower into the fall as we do see our calf run and the supply gets a little more available. Now this break could be more muted where it doesn't have to go as low, because there are just going to be fewer calves available as we look ahead and we consider the cow herd size. But this is already starting to show up in these spreads. We saw it some last year where so this is looking at the feeder cattle and calves as a percent of the fed cattle. So if this is higher, that's showing that they're outpricing the fed cattle by a larger percentage. And so you can see that during the last cattle cycle, this got to pretty extreme levels. We're not expecting quite as violent of an increase, but that's not to say that it's not possible. We're expecting just a little bit slower of and less rapid of a cycle this year, or this time around, which might keep those spreads from getting quite as wide and keep profitability moving throughout all levels of producers as we look ahead. But even still, this should continue to stay wide or get wider. and just pass more money back down to cow-calf producers and the stocker operators. If we look at utility cow prices, those are running really strong compared to year-ago levels already. Expected to average about $20 a hundredweight higher. And that's really coming out of the fact that there's just fewer slaughter cows, and then that the 90s lean trim has really been pricing strong. So between those factors, that's really been supportive to this utility cow price, and expect to continue to see that. But there will still be somewhat of a seasonal break as we look at the end of the year, just out of the fact that that's whenever you typically see more come available. But all in all, this has average cattle prices trending higher, at least for the next couple of years. So probably a slower rate than what we've seen in the last couple years, but still trending higher into 2025 when we see our beef cow herd low. And then as we get into the larger supplies, that should turn prices lower for the next phase of the cattle cycle, but trending higher through all levels of the cattle cycle, and also throughout the cutout too. One more slide. I want to go over the bred cow price. So that has been moving higher, and it ought to average this year at new highs. But even at these new highs, comparing it to this fed steer value, I think really puts it into perspective of why these bred cow values are able to go so high, because of those calf values and feeder values moving with it and then passing down to the fed steer as well. So these prices might seem extremely strong, but as you consider what fed steer prices are and the weights that they're able to get to now, it makes a lot of sense compared to this historical relationship and what we can expect with inflation and all the other levels of prices. That's all I have. I'm going to pass it over to Matt, who's going to talk through the cow-calf survey results that he's got.
Thank you, Mary. So as Mary said, we will move into the cow-calf survey results at this point in time. If anyone on this call contributed results to this data set, I want to say thank you very much. Having a large sample size really helps us create accurate results and track these metrics across time. So again, this is my summary slide for results from the 2023 cow-calf survey. Average cow herd size in this sample set was 345 head. Looking at cash cow costs, those were up $41 at $723 per head. This is a record high value in this data set or across this time frame. Important to note that this cash cow cost, I will reference this number a lot moving forward, but this does not include those non-cash expenses. So any unpaid returns to labor and management or unrecorded depreciation costs were not included in this metric. We did ask that as a separate question, and that was estimated at around $200 a head. But again, I want to just make sure to point out that as we move forward with this presentation, that everyone understands that these are just cash cow costs. Then looking at calf revenue, that was up almost $400 from the previous year at $1,421 per animal, per calf weaned. That equates to $264 per hundredweight value for those calves. And then as we look at the average weaning weight, steer and heifer average was up 2 pounds from 2022, but for the most part, that's pretty steady. Looking into the future, around 44% of producers intend to expand over the next 2 years, while about the same percentage expect to maintain about the same herd size. Looking at regional cash cow costs, we did see a pretty big jump across the regions. If you remember, the U.S. average was a $41 per head increase from 2022 values. And as we break it out into individual regions, the North Plains continued the trend of having the highest cow costs. Again, this would be due to larger feed and pasture expenses, but they also saw the greatest year-over-year increase in cash cow costs, at an $80 per head increase. Then looking around, more moderate increases across the rest of the regions. Southeast region continued the trend of having the cheapest cow costs or the lowest cow costs, but they made up for it by having discounts on their calf prices just due to the freight to get it out to the more central United States. So we break down those cash cow costs. Feed and hay was the most expensive or the largest makeup of that cash cow cost. Feed and hay surpassed pasture as the #1 expense a few years ago, and that's primarily due to the lingering drought conditions. But again, those two components make up the largest portion of cow costs. That's followed by overheads, which came in at 12%. Those are our more of those indirect costs. That could be like facilities, repairs and maintenance, and then utilities, gasoline, fuel, stuff like that. The supplies and miscellaneous, vet and breeding, and hired labor rounded it off, and those came to about 25% of cash cow costs. And so as we look at these results, we break out results both by regions and then by return groups. And so how we do that is we take the average cow cost or reported cow cost for each producer. We adjust that by the weaning percentage, and then we subtract that from the calf value to calculate a basic profit value per head, or like on a per calf basis. And so that allows us to kind of segregate producers or segregate responses a little bit and take out a little bit of that economies of scale factor. And so as we look at that, we break those operations out into high return, average return, or low return, again, based on this simple profit margin that we calculated. And so as we look at this first slide, these high return producers are in those gray bars, and we're looking at calving length or calving interval, in which 75% of that year's calf crop was born in that first 45 days or 45 to 60 days or within the first 90 days. And so when talking about this variable or this factor, I usually like to focus on the first 60 days, but as you look at that 46 to 60 day columns, those values were identical across all of those. So we'll just focus on that first 45-day group. So here you can see the primary difference is that high return producers were more likely to calve within that, or have 75% of their calf crop on the ground within that first 45 days. And then on average, when we combine these values, 80% of producers on average had 75% of their calf crop on the ground by day 60. So that's pretty good. Again, environmental conditions play a huge role here, along with management practices. So this is one that is good to know, but is maybe not as practical for some producers to manage or shorten. But as we look at this, again, this shows that the percentage of calves weaned per exposed female. So this is our calf crop or our weaning percentage. And so again, maintaining that low return, average, high return estimates. Here we can see, if we look at the far right column, this is the average, U.S. average for the last 3 years. We did see a little bit of a drop this past year. Talking to some producers, quite a few of them saw decreased pregnancy rates this past year or with the past calf crop. And that's again due to those lingering drought conditions, just making that breed back a little bit more challenging. But aside from that, the overall trend across groups remains the same, whereas high return producers were more likely to have a higher calf crop percentage. If we look at the 3-year average, there was about a 5% difference in calf crop percentage from those low return producers to high return operations. we use this year or this past year's average herd size of 345 head in this data set, that would equate to about 17 more calves to market. So that 5% adds up pretty quick, or is a pretty substantial value when you consider your bottom line. Again, I do recognize that calving interval, it's really easy to stretch out as we look at it, but it has very impressive benefits to the bottom line. And so as we combine both of those factors, that weaned calf crop percentage and calving season length, we get this top chart, which shows that a tighter calving window is more highly correlated with increased weaning rates. This is due to cow physiology. Just if animals calve earlier, they have more time to undergo that uterine involution process and be able to breed back at a higher rate the following breeding season. And so by having that more time to recover, that again creates this little bit of a cycle that allows them to have that higher weaned calf crop percentage. Then as we consider that, we incorporate calf value on the right axis of this top chart. You can see the breakdown of that 2023 calf value by those calving season lengths. And so again, higher weaned calf crop percentage did contribute quite a bit to the overall net result. But then we also just have to consider the fact that the bottom chart, looking at this, that'd be weaning weights by our calving season lengths, our calving intervals. And so there, this one's a little bit more self-explanatory. As you have a higher percentage of your weaned calf crop born earlier in the season, that just gives them more days to add weight and reach their genetic potential for weaning weights. And then furthermore, that again translates back to a higher calf value per head, because it allows operations to market a heavier, more uniform calf crop compared to some of these operations with a little bit longer calving interval. The last 3 years, we've seen an average of 15 pounds difference between these, or of weaning weights across these different calving season length groups. And so again, we have to recognize that that contributes to about a $40 per calf interval, or per calf difference across groups, and that's for the entire herd average. So again, substantial driver to the bottom line if that can be tightened up a little bit. And so as we talked a little bit about weaning weights on this the bottom part of the slide, and as we convert that back to a return basis or evaluation on a return basis, again, you'll see that that steer heifer average weaning weight on that left-hand axis increased over time, or increased by return group. So a pretty strong correlation here. As we look at the bottom chart, you'll see that from 1980 to 1990, calf weights added about, or calf weaning weights added about 5 pounds per year. And then from 1990 to 2020, 2021, we only gained about a pound per year in overall weaning weight. And then the last couple of years, we've been down on average of combined, on steer weaning weights of around 5-6 pounds for both 2022 and 2023. This is suggesting that we're likely approaching that overall threshold in which we can push steer weaning weights from an efficiency and cost-effective manner. We can always make those a little bit heavier, but again, we have to consider the costs associated with that. And so as we recognize that weaning weights are approaching that upper threshold with where we can put calves at 205 days, that underscores or increases the importance of other factors such as weaned calf crop percentage. And so moving on to a little bit past the weaning stage, we ask respondents or producers how they, or if they wean their calves, or if they ship them straight off the cow. Across time, this is usually a fairly consistent measure. And so again, that percentage of respondents that follow each of these weaning practices is indicated on the left-hand axis, and then those values on top of the bars represent the calf value at the time of weaning. And so as we look at this, calves that were weaned for over 45 days, on average, were worth more than any of the other groups by quite a bit. And again, in this survey set, that makes up the bulk of our producers too. 55% are taking advantage of premiums offered by weaning calves for over 45 days. We looked at the values between calves that were shipped off a cow and then weaned less than 45 days. There's actually a small drop off from that within that first 30 days before it jumps back up within that 31 to 45 days. But again, there's not a huge difference there from shipped off of a cow. And so what this tells us is that if a producer wishes to wean their calves, they really need to do it for at least 45 days if they're going to capture those added premiums, particularly to be able to cover the costs of that increased risk of morbidity and mortality associated with that weaning time frame. What's more, calves that are weaned, operations need to be sure that they advertise that at the time of sale, no matter what form of marketing they use, to be able to capture that added value. But again, as we look at this, there's a $100 per head difference between calves that were shipped off a cow and weaned for over 45 days. And so that becomes a question of cost to gain analysis, where if you can carry a calf and for less than $100 for over 45 days, and you can make back that little bit of loss in initial weaning weight from that weaning period or weaning process, then it pencils out for a lot of operations. Looking at marketing avenues, the bulk of our respondents continue to auction or market cattle through the auction barn. We have seen a slight increase in forward contract and video sales over the last few years. And video auctions typically do capture a premium compared to auction barn calves. Part of that is the seasonality of the market. And then also a lot of that is due to calves in video sales oftentimes having more value added options that they're enrolled in or being weaned in or being part of a vaccination protocol. And so again, this kind of shows the difference in value that can be gained from some of these other options. This past year, 24% of respondents indicated that they did not market calves through an auction barn, through direct trade, or a video sale, and so they were likely retaining ownership. We have seen a small decline in the past 3 years, and I expect to see another decline in that percentage this year, just as more operations look to just go ahead and capture value at weaning instead of trying to hold calves longer. And so again, this is something to think about as you look at this year's calf crop. Along similar lines, looking at value-added programs, the bulk of our respondents, 67, 68%, indicated that they do not follow any of these listed value-added programs. But the producers that do follow these programs, they increase the percentage that they do, or in which they're enrolled in these. And so they are offset because producers are able to participate or check the box on multiple of these programs. And so that kind of explains that difference, why these increased while number of producers that did not participate also increased. But as we look at these, source and age verification has stayed pretty steady. Non-hormone treated cattle jumped back up a little bit, so did verified natural. We have seen a fairly steady increase in processed verified calves over the past few years. Some of that is due just to the creation or more wide adoption of beef care program, that process verification. And again, that will likely to continue to increase at a small pace. Vaccination protocols. The last 5 years, these values have usually been, or these bars have almost been identical. We did see a little bit of difference this past year compared to previous years. That number, or the vaccinations that were given prior to weaning, dropped off, while vaccinations at branding and at weaning increased, likely carrying away some of those responses. But as we think about how this adds value to the calf, this top chart shows the number of times calves were vaccinated, and it shows the calf value on a per head basis on that left axis. Then those values at the top of the charts, or top of the bars, just represent the percentage of respondents in 2023. But as you can see here, over the last 3 years, on average, around 30% of producers have only vaccinated calves one time, while over 60% of producers or operations vaccinated at least twice. And so again, that value, or that percentage, holds again true this year, where the majority of our respondents indicated that they vaccinated calves twice. And this is one of those charts that shows a pretty strong correlation between the number of times vaccinated and the calf value up to a certain level. And so as we look at this, calves that received no vaccination had a $113 per head discount compared to calves that were vaccinated once, while calves that were vaccinated twice received a $141 per head premium compared to those that only got one shot. And so as we've looked through this over the past few years, it's really kind of stood out that at this point in time, most buyers expect at least one round of shots in these calves and would prefer 2 rounds of vaccinations. Looking beyond 2 shots, there's a little bit of increase in head or value per head for 3 and 4 shots, but more of a marginal increase at that point in time. And as we think about why that is, when calves are given vaccinations, it really boosts their health and growth potential at key points when they're developing calves. And so it just physiologically leads to heavier weaning weights. But again, here, when you see that number of times vaccinated on the bottom chart, 2 times seems to be the magic number, because after that, there is less of a steer weight gain for 3 and 4 vaccinations. And so again, this is one of those values where we recommend around 2 vaccinations if possible, and 3 or 4 can be beneficial if those calves can be marketed in a way that captures back that increased cost associated with drugs and labor. Another common trend across time is correlation between bull purchase price and calf value. So as we look at this chart, the height of the bars represents the calf value with the corresponding bull cost, which is displayed in the color of each chart or bar. And so as we look at this, so for example, 2023, if we look at bulls that cost less than $3,500 and then compare that to the blue line or blue bar, where bulls cost around that $4,000 mark, we saw a $140 per head increase in calf value between those groups. And then likewise, we saw an increase of $65 per head in calf value when increasing bull costs up to that $5,500 to $7,500 range. And then again, another $75 head increase in calf value for bulls that cost over $7,500. And so this suggests that there is a opportunity to spread out these costs of more expensive bulls across multiple calves and multiple years. While this doesn't work for every breeding program, depending on how the calves are marketed and how replacement females are kept back, the data does suggest over time that investing in genetics of the herd pays off or pays dividends back to the producer. So as we look at this, this just illustrates some of those values we just talked about. Took the averages for calving interval, number of vaccinations, bull price, and pounds weaned per exposed female, and converted those to an index based on calf value. And so as you can see, and I should point out that calving interval was inverse. So the tighter calving interval resulted in, or was more highly correlated with heavier or more expensive calves. But as we look at this, there's more spread or more variation on the bottom side or within those lower priced calves. And then as we got to the higher priced calves, so say those above $14.50, $15.50, we saw small increases in calving in a tighter calving interval and a number of vaccinations, but those plateaued off. So they reached that level. So for calving interval, that'd be around that 60-day mark. Number of vaccinations would be around 2.5 vaccinations. Where you can see here, it didn't really add a ton of premium to those calves. Whereas like bull price and pounds weaned per exposed female, those factors continue to grow at a little bit more of an exponential rate in terms of contribution to the overall calf value. So again, coming back or circling back to those producer return average groups, this kind of summarizes it all and puts it all together. So again, we calculated that simple profit margin that was based on adjusted calf crops for calf value and cow costs, and that's shown in this red line here between those low return average and high return producers. And so again, that red line just shows that simple calculated cash profit. And so then as we look at these groups, we'll start with the cow costs, which is the green line here. You can see that low return producers had a much higher cow cost compared to those average return operations. There's $188 per head average difference in cow costs between that low return and average return, while the average and high return groups were a little bit more similar in their cow costs with only a $63 per head decrease. Looking up at the calf value, low return and average return producers have very similar calf values. There's only a $52 per head difference, whereas average and high return operations had a $216 per head difference in overall calf value. And so as we kind of step back and look at these results, this tells us that on the cost side, the difference primarily lies within the low return and average return producers in terms of cow cost, whereas calf value differences primarily lie within the overall average and high return groups. And so this tells us that if, say, a producer finds himself in more of the low return group, they can make quicker improvements to their bottom line by focusing on reducing cow costs, whereas producers maybe more in that average return group can find ways or find better advantages or quicker advantages by focusing more on their marketing side, so more on the calf value aspect. In conclusion, again, high return producers focus heavily on the animal health side, the value added programs, nutrition and genetics. And then they convert that into a improved marketing program or strong marketing program that advertises their efforts and captures those values. And then again, that then ties back to reproduction, which finally circles back to the animal health, nutrition, and genetics. And so it creates a self-sustaining cycle. So at this point, we are happy to entertain any questions that you all may have. Feel free to type them in the box, or if you think of them afterwards, feel free to email Mary or I. We'll be happy to get back to you.